SDO trade setup netted me $9,391 to date. In this video, I will discuss SDO Trade Concept. This is another popular setup of mine. First, I will break it out into 3 parts. The SDO Trade Concept itself. Then I'll break it out by SDO Trade examples. And last, I will share with you guys some of my SDO trade results via TradeZilla. Alright, first let's define what is SDO Trade Concept. SDO is an acronym that stands for Swing Trade with the possibility of Day Trade using options. So keep in mind that this is still swing trading criteria with the possibility of day trade. This strategy requires you to have a basic understanding of covered call options. And I will cover covered calls in a few minutes. So options probably have the steepest learning curve, among the asset classes like stocks, ETFs, bonds, mutual funds, and futures. This SDO trade concept is great to implement for those who have a day job, or maybe you want to make extra money without actively day trading. So the first step is our stock or ETF RSI daily candlestick less than 65? Similar to the previous video that I mentioned, right? So if the answer is yes, we move on to the second step. The second criteria is, do you think this stock or ETF will move up in the long term? This is important. It has to be on a stock or ETF you believe it will do well in the long term. If the answer is yes, we move on to step number 3. Step number 3 is, do you think this stock or ETF will move down or sideways within the short term? So meaning, do you think within the next few days or next week, it will likely move down or move sideways as opposed to going up? If the answer is yes, then it only makes sense for us to buy 100 shares of XYZ stocks or ETF. Now, normally I have performed this setup on ETFs. I also done it on stock. To me, it makes more sense to buy on a leveraged ETF because you ended up collecting more premium off it, and there's more volatility involved. Step number 5, we sell cover call options 1 to 2 weeks out with 1 to 2 strike prices above our purchase price, which means we have to open an entry that involves sell to open as the action. And we'll cover some examples in a few minutes. Step number 6, give it some time and we'll wait for the stock or ETF to move. So that's pretty much the setup for SDO. All right, next, let's cover some of the profit outcome scenarios. There are a few ways to make profit. Scenario A, cover call options expire worthless. You collect full premium. Scenario B, cover call options expire in the money and you collect full premium, and the stock ETF gains, the contracts get executed. Scenario C, cover call options market price worth less than what you sold for. Then you can buy to close to collect partial profit. Now, some of you probably understand the concept of cover calls. Some of you probably don't know what it means. So let's go ahead and dive into cover calls. Okay, here are some key concepts for cover calls. Essentially, you have you, which is represented in this green area, and the other random person, which is the buyer. So let's cover the seller side, which is you. You own 100 shares of stocks or ETF you believe will do well in the long run, but you believe it will have short-term down volatility, or maybe it goes sideways. That's when it makes sense to sell cover calls. So essentially, we want to sell one cover call option to this random person who happens to be the buyer. In order to sell one cover call option, you need to own 100 shares of stocks or ETF. Essentially, you give the rights for this random person to buy your stocks or ETF at the agreed upon strike price on or before expiration date. So here's one example. Let's suppose you own 100 shares of SOXL, which is a leveraged ETF. Expiration date is on November 22nd, 2024. Strike price of $32, 100 shares. So Schwab, Robinhood, Fidelity, there's something called sell to open. And for the type of option, we want to select call. So in return, the random person on our right-hand side, the buyer, buys one call option contract from you. By buying one call option contract from you, you receive the premium. So let's suppose that for this SOXL cover call option, this person is willing to buy from you for $2. Now, $2 is how much it's worth per share. So when you take $2 times 100 shares, this person will pay you $200. So for this random person or the buyer side, ticker will be SOXL. Expiration date is November 22nd, 2024, with a strike price of $32, 100 shares. Action will be buy to open. Type will be call. So on the buyer side is buy to open. On the seller side, sell to open. NVDL is the leveraged ETF for NVDL, and I performed this SDO strategy numerous times. So let's go ahead and navigate to, let's say, July 11th. So on July 11th, I opened to sell summon contracts for 40 cents. Later on that day, I have closed out my contracts. And the timestamp is not correct because Fidelity doesn't capture timestamp. But this is the next sequence order. So I close it out by buy to close 25 cents, which is $25. I made $105. That same day, I noticed that NVDL actually went down further. So I went ahead and sell to open on the same day, maybe hours later throughout the day for $70. So 10 times 7 is 70. The next day, I later closed it out for $28, netted $42. I've also prepared an Excel example here. On July 11th, 2024, I sell to open to collect $280. $280 stems from $40 times summon contract, which is $280. The same day, on row number 6 here, I later then buy to close because NVIDIA actually went down in price. So hours later, the stock price went down. When it goes down, NVDL market value goes down. That also means the call options off NVDL also goes down. So later on throughout the day, it only worth about 25 cents. So, we can go ahead and take 25 times 7. It costs me $175, which is why I've highlighted this in red. If we netted 280 plus minus 175, netted $105, right? That was the first part. Throughout that day, I later then sell to open another summon contract, this time at $70. 70 plus minus $28 gives me $42. And just based on these two transactions, the total net collected was $147. Not only that, I still own 700 shares of NVDL. I was able to repeat this process throughout the next day, the next month. In fact, NVDL actually went as high as $86 as of November 16th. Okay, let's look at scenario B. Your cover call options expired in the money. You collect the full premium and you made a profit off your stocks or ETF. So this is another possible scenario. So let's say NVDL on July 12, 2024 is now valued at $84 a share. So again, we use the same example from the first example here, right? So we're assuming that the NVDL contract was sold at $83 strike price, summon quantity, sell to open. So on July 12th, NVDL is now $84. That's above the strike price. That means the buyer is going to execute the contract, right? For this scenario, this means that you will also sell your shares at a profit. Let's assume that our cost was $81 because the strike price is $83. $83 minus 81 times 700 will give us $1,400 profit. Even though NVDL is $84 currently, the math is not based on $84. Remember, we have a contract we both agree upon. So the math is the strike price of $83 minus your cost, which is $2 difference. Take $2 times your share, 700, which is $1,400. If we add up the premium plus our shares profit, that gives us $1,400.40. So this is why this is by far my favorite strategies when it comes to swing trading. SDO Trade gives you the highest profitability of making money. In fact, if we go back to NVDL, most of these NVDL SDO trade setup netted me $9,391 to date. The only time I would say it probably wouldn't make sense to sell cover call options is possibly during earnings. especially for NVIDIA, and this is me speculating. NVIDIA earnings is coming up actually next week, and a lot of analysts, including myself, were speculating that the earnings will actually do really well. NVIDIA did not include their Blackwell chip last time, and I think that didn't really impress the investors. And that's one of the reasons why their stock price actually went down after earnings. On August 28th, after earnings, their stock price dipped and it closed at $116. Now, NVIDIA's next earning will be on November 20th. So a lot of analysts, including myself, were speculating that it will likely exceed the expectations of earnings per share and revenue. So this is the only time period where I'm kind of iffy on selling call options. But if I sell cover call options, it's fine. If it goes up, and if it goes up above the strike price, we'll still make money off scenario B. If it doesn't go above the strike price, we'll still make money off collecting premium, which is scenario A. If NVIDIA doesn't go up, that means NVDL will go down in value. Call options worth less, which we will collect the premium and we still own the shares. And we could also close out the option contract earlier if we want to. So regardless of what happens during the earnings, we'll make some sort of money no matter what. And that's why I prefer SDO as my favorite setup strategy. July 8th, I collected $1,642. July 9th, I collected $44. July 10th, collected $1,278. And there were multiple transactions after July. I kept on repeating the same process over and over. Now, of course, on some days, I was able to capture more net profit than others. It really depends on the timing. If I time it correctly, it is possible to capture a larger amount comparing to other days. But yeah, this is one of the safest strategy I would recommend for swing trading. So let me just go back to the three scenarios. Scenario A and B, you will collect the full premium regardless if NVDL goes up the next several days or if it goes down. You'll collect the premium no matter what. If NVDL goes down, then you can continue to repeat A because the call option expires worthless and you will collect your money. Now, scenario B, if the cover call options expire in the money, meaning NVDL went above the strike price, you end up selling your NVDL shares, which is fine because then you'll make the money off the shares. Scenario C is the cover call options market price worth less than what you sold. Rather than me waiting for the expiration date, I ended up just performing a buy to close to collect partial profit. So I will review some of my thought process using this SDO trading strategy. So basically, regardless of the stock market outcome, you will make profit, especially if you're going to sell weekly or 2 weeks out options. You're able to make money faster. So you can either wait for the option to expire or just buy to close the option to collect your premium. So I've executed this strategy on single lots. That works fine. I've also noticed that it's better to perform this strategy on multiple lots, meaning don't buy all at once. Maybe just buy the shares at different prices so that way it lowers your dollar average cost. And also, it seemed to work the best for me when I sell cover calls on leveraged ETF, but it must be on a leveraged ETF that I believe will do well in the long term. So these are some of my favorite leveraged ETF: SOXL, NVDL, NVDX, which is the leveraged ETF for NVIDIA. AMDL is a leveraged ETF for AMD. AVL and TQQQ, leveraged ETF for NASDAQ. So these were some of the ETFs that I implemented this SDO strategy. So SDO strategy probably makes up a large part of my profit. Well, that's all I have. I hope everyone finds this video useful. Don't forget to like and subscribe. I'll talk to you guys next time. Peace.